Welcome back, everybody, to Volatility Trading Strategies. Today I'm going to go over the full details of our defensive rotation strategy, which targets a higher rate of return, but still has some very effective risk management built in. This is a tactical strategy that rotates between the Nasdaq index in good times, and then either utilities, bonds, or cash for our safety positions to protect against market drawdowns. So I think a lot of you are going to be very interested in this strategy, and by far the best way to see how it works in real time is to take the free trial to VTS that's available to everybody. And even if you've done it before, go ahead and take the free trial again because there's been many new additions to VTS over time. So like I said, this is a tactical strategy, which means it's rules-based and it's going to be rotating between various positions depending on current market conditions. Now, for me as a volatility trader, that's where I'm getting my data. I think the volatility complex is by far the best way to get reliable trade signals. So how it works is, I'm able to priority rank all the important volatility metrics, and then we allocate capital to only the asset class that has the highest probability of success given the current market. Now, the heart of the strategy is equities based, and anytime volatility is in what we consider mid-range, basically stable markets, we'll be holding the Nasdaq index in the form of the 2x leveraged ETF called QLD. Now, I do want to make clear here that for investors with lower risk tolerance, we do have the non-leveraged version of the strategy as well. That one just holds the 1x ETF called QQQ. Everything else about the strategy is the same, so subscribers just choose between the 1x QQQ or the 2x QLD depending on their own level of risk tolerance, and everything else is identical. So during mid-level volatility, we'll be holding the Nasdaq index. Now, this chart here is showing just the days when the strategy was holding the Nasdaq, and we can see that that happens on about 61% of trading days. And performance-wise, 23% of the total 35% annualized return of the overall strategy is just from the Nasdaq. So you could say the growth engine is that mid-volatility range period. But this is where it gets interesting, and anybody who invests in the stock market needs to pay close attention here, because this is the QLD during the financial crisis in 2008. And that's an 84% drawdown you're looking at, which took over 5 years to recover from and finally clear that previous high from 2007. And for this next one, it should have an R rating stamp on it, because here is just the 1x Nasdaq index going back to 1999. And that's an 83% drawdown with a full 16 years of recovery just to clear the previous high in 2000. So when volatility starts to get elevated, we rotate out of stocks completely and we move into the XLU, which is the utilities ETF. Utilities tend to perform much better than the stock market during times of elevated risk and uncertainty. Here's just those XLU utilities positions that are held on roughly 14% of trading days. It's just a safety position, but it's extremely important for the overall strategy to have an exit plan before the real trouble arises. Remember, despite massive government and Federal Reserve intervention, at some point there's going to be an extended recession. Now, I have a good plan for how I'm going to deal with it, and you better make sure you do as well, because the next recession, whenever that happens, given the fact that the puppet masters have got to be out of bullets at this point, could be one for the record books. And that's where this next position comes in, because on about 8% of trading days with the most extreme volatility readings, we'll be holding literal cash, just fully on the sidelines in safety. Here's an overlay, and all those red periods are when the defensive rotation strategy was in actual cash. The underlying black line there is the S&P 500. And we can see that we do have to move to full cash during those larger market declines. Now, sometimes they bounce back quickly in this buy the dip environment, but like I said, there's going to be a time in the future when it really doesn't. And that's when we get to feel like a rock star for avoiding the worst of the crisis. And then the last part of the strategy is what we do during very low periods of volatility, which happens on the remaining 16% of trading days. For this range, we're holding the VGLT, which is just a US Treasuries ETF. This is one of the very few times within any of our VTS strategies where we actually hold bonds anymore. Given where interest rates are right now, they don't actually reduce risk as much as they used to. But for our purposes in this low volatility range, they are still useful. Here's a comparison of those VGLT bond positions in orange, and then red is what it would look like holding the S&P 500 instead, which we can see is a lot worse than bonds, so they still do serve a purpose. This happens because the only time we ever see these low volatility levels is at the end of longer term trends. And by that time, typically the stock market is running on fumes anyway and looking for a short-term pullback. So obviously the strategy destroys any underlying benchmark, but when you're dealing with the Nasdaq index, because we do want that outsized return, larger drawdowns just come with the territory as well. But that's why we rotate through multiple positions, and also why we trade a diversified portfolio with many other strategies that have different market bias. Remember, during the next recession, it won't be surprising at all to see the Nasdaq index draw down 70 or 80% and take 5 years or longer to recover from. That's why we take our safety positions so seriously. And I've made it very easy to follow for subscribers of VTS. Whenever there's a new trade required, it's clearly marked in both an easy-to-read table, and there's a trade dial as well for signals at a glance. And you can just go into your trading software and execute it. As far as trade frequency goes, this isn't a strategy you need to be parked in front of your computer for. The defensive rotation averages about 3.5 trades per month, so we're talking about maybe 10 minutes of actual trading spread out over an entire month. Trust me, anybody from any background can easily follow this strategy, so make sure you do claim your free trial. You'll see the full defensive rotation strategy in action, plus the strategic, balanced vol trend, and the full volatility dashboard. Feel free to join the VTS community anytime. Thanks for watching.